Sell call options for income. How to sell call options using charts is what we are discussing in this video. This channel is all about trading stock options. And because stock options are a derivative of stocks, it's indirectly also about the stock market. So if you like the stock market, if you like stock options, or if you're curious about either one of those two, consider clicky on that subscribe button so I can help you on your trading journey. As I was saying, this video is all about selling call options for income using stock charts. And at the end of this video, I've got some free gifts for you to help you in your trading journey. So let's get into talking about generating income by selling call options using charts. Well, if you don't know what a call option is, maybe we should start there. Call options are derivative contracts. What's a derivative? Derivative derives from the word derive, which means obtain something from something, right? In this case, it's obtaining value. The call option is obtaining its value from something, which is the underlying asset, the stock. So what is a call option? A call option gives the buyer of the call option the right to buy stock. So you're buying a contract that gives you the right to buy stock at a predetermined price, called a strike price, for a specific period of time, called the expiration date. Because the call contract derives its value from the underlying stock, options are known as derivatives. The buyer of the call option contract pays money to the seller, called a premium, for the seller's obligation in this transaction. Since you will be selling call options, you, my friend, will be receiving this premium. Yay! Basically, there's two ways to sell call option contracts for income. One is called a covered call option, and one is called a naked call option. We're going to be talking about the differences, but in the big picture, the difference is low risk or high risk. As a call option seller, you are being paid for the obligation to deliver shares of stock at a certain price if requested of you, which is normally the stock closing above the strike price at the end of the expiration date. If you do not own stock to fulfill your obligation, then you are selling a naked call option. Naked because you are exposing yourself to theoretical unlimited losses. Disclaimer: even though there are things to mitigate this risk afterwards, let's focus on not getting into a position that you need to scramble for protection. So we'll look at this chart here. We're going to pretend that this is a daily chart. So each one of these red or green candlesticks represents one day of trading. And let's say you, on this day right here, decide to sell a naked call option at this strike price right here. So this is the day that you sell it, right? And then this is what unfolds. Drops down, but on this day it goes over that strike price, and it continues to go over that strike price. And now here's your expiration period right here. And so because you have made the legal commitment to sell shares of stock at this price, you are required to go into the open market and buy shares at this price to turn around and sell shares to someone at this price for a loss. That is the theoretical unlimited loss, because theoretically stock can go infinite to the upside. Now the other type of option call option contract you can sell is a covered call option. So if you have shares of stock to fulfill your obligation, then you are selling a covered call option. Option contracts work in increments of 100 shares of stock. So you would need 100 shares of stock to cover one call contract and so on, right? 100 shares to cover one call contract. That means 200 shares to cover 2 call contracts, right? 300 shares to cover 3 call contracts. Easy math. As long as you select a strike price that is higher than the amount you purchased the stock for, you cannot lose money, but you theoretically limit your profits. Let's look at that again. The same chart. Pretend it's a daily chart, so each candle represents one day. We're going to look at that same strike price. Well, let's say instead of selling the naked call option, you buy 100 shares of stock right here. And you turn around and you sell a covered call option with a strike price right here. And then what happens is that by the end of your expiration date, the stock is trading up here. Did you lose any money? No, because you bought it here, you sold it here. You made a small profit and you received premium up front. But you didn't make as much money as you could have because the stock ran all the way up here. If you like this, and if you want to start implementing this a little faster without learning the chart part, then click this link right here, which is going to be a video to show you how to sell put options to acquire stock, and then how to sell the call option to exit the position. However, I think you should stick around until the end so you can watch that video later. Come back. It's around 7 minutes. Come back and watch that video later so you can find out how to set up your stock charts in this video, plus get those freebies. Speaking of stock charts, here's a snapshot of a stock chart that I actually sold a covered call option on quite a few weeks ago. This is what I was looking at. So it was on this day right here, and I wanted to sell a covered call option, but I didn't really want to have the stock called away from me. I'm okay with having it called away, but I didn't really want to. So first thing I noticed is I saw this little bit of resistance right there. The stock rallied up, it touched this point, and then it broke down. It went all the way back here. The next thing I noticed is it did the same thing over here, right? It rallied all the way up here, even gapped up here, but it really couldn't break this area, and it fell back down here. So now what do I see is I got a high and I got a lower high, and potentially a lower high right here. So what I looked at is, could I sell a covered call option at $8.50 strike price? Some of the other things that made me be interested in this, because I kind of wanted to keep the stock, is this is volume, and I saw there was a high amount of selling volume coming in. So I was thinking, yeah, you know what? High, lower high, lower high. Maybe the stock can stay under $8.50 during my expiration period. So then what I did is I went to my brokerage account and I went to what's called the options chain. Now this is just a two different snapshots of an option chain. We're looking at the call side, and normally what happens is on the left hand side of the call of the option chain, you'll see the calls, and on the right hand side of the option chain, you'll see the puts, and in the middle you'll see the strike price. Strike price again being at the price that you're agreeing to sell stock at. And so our strike price, and I'm looking at the 850. So I found 850. Now I want to see how much money can I make for selling that. So under the bid and the ask, when you're selling, you're always going for the lower, you're always going to get the lower number. When you're buying, you're always going to have the higher number. That's just how it is. So I see that for selling a call option at the 850 strike price, right there, I can get paid 5 cents. But remember, that's 5 cents times 100 shares. So I get paid $5. Now, maybe you don't think that's very exciting. Well, if you're making this much money, zero in the stock market right now, is making $5 more exciting than making zero? You be the judge of that. For me, it would be more exciting. But you're not limited to just one contract. You can do 2 contracts. You can do 10 contracts. You can do 20 contracts. You can do whatever you want. This is very scalable. That's why this is awesome. You're only limited by how much money you have when it comes to the covered calls. So that's exactly what I did. I sold at 850 and I brought in $5 times how many ever contracts I sold at. Now let's look at setting up your charts so you could do something similar. Right? So you're gonna have some sort of brokerage account, right? And then one of the first things that I'm going to advise you to do is put on some moving averages. And these are pretty common, right? Definitely a 200-day moving average. These are the 3 that I use the most, right? 200-day, 50, and a 20, and a 20, 25, depending on the charting software. But if I have my choice, I'll use the 20. So what are these moving averages? Well, for whatever days that we're looking at. So in this case, this indicator is taking the last 200 days of trading, looking at the closing price for last 200 days, adding them together, then dividing by 200, and then graphing it out here, right? And it creates this line. 50 days, the only difference is that instead of adding up 200 days, adding up 50 days, dividing by that amount of days. Same thing with the 20-day. Now, what is powerful about this? What's really powerful about this, with a very quick one look, we can see what this long-term trend has been doing over the last 200 days. We see a medium-term trend, 50 days, and we see with this 20 days, a relatively short-term trend. Now, you could go 9 days, you could do 5 days, you could do whatever to get shorter-term trend, but this works well for me, so I do that. There's other types of moving averages. I use the simple moving average. You could use the exponential moving average. Use whatever kind of moving averages you want. Play with them. See what you like the most. Now, where do you find those at? You'd find them somewhere up here if you're using Tastyworks, which is this brokerage account that I'm looking at this chart from. You'd go to the indicators. Now, Thinkorswim, I think it's called Studies under Thinkorswim. I think a Webull makes it a little easier, but you might have to click around. You might have to look around, but it's somewhere there, right? So now we got our moving averages set up. So what are we gonna do next? Next thing we're gonna do is we're gonna put on something like this. We're gonna put on some sort of either the MACD or some sort of stochastics to help gauge, right? To help gauge. It's not an absolute. It's helping. The MACD, stochastics, these moving averages, these are lagging indicators, right? They're lagging behind. It's taking old data and crunching it into some mathematical formula and giving you some output to give you an idea of what's been happening in the past. It's a lagging indicator. What is not a lagging indicator? Bam, the current price, right? So you know how they say past performance isn't necessarily an indication of future performance or something like that. So you got to kind of keep that in mind. Right, so now we're going to put on MACD or some sort of stochastics. There's a lot of different settings that you could use with the MACD and stochastics. With stochastics, there's like slow stochastics, fast stochastics, full stochastics, and all these different things. I think most of the time, depending on the way that I'm using them, I'm generally setting it up on like slow stochastic because I'm looking to have it help me gauge a trend, right? So I want to see this bigger picture. MACD, I think there's a couple other things that you can set up, but just put something on there, right? Use stochastic, use MACD, get something going so you can take a look. Where do you find that at? Same spot, or at least in Tastyworks. And then, now that we have the chart set up, we're going to start by looking at the monthly chart. The monthly chart. How would we know if it's a monthly chart? Right up here. See that M? This M right here? That is where we're going to start by looking at this monthly chart. Why? Why are we looking at the monthly chart? Because we want to get an idea of what is the big picture. The monthly chart, what the monthly chart is specifically, is each one of these Japanese candlesticks represents 1 month of trading. So this month it went up, this month it kind of did this doji, for another month it kind of went sideways this month, right? And so we want to see this big picture trend. And now I look at the MACD and I see that, and when I'm looking at 3 years of data from left to right, each candle being 1 month, so I see that lately, the last X amount of months right in here, it's been this downward trend. Now, when I'm looking at stochastic, see the gap between these two lines? Here the red crosses over under blue. It's going to this downward trend, and I see this big gap between these two lines. That's telling me it's a pretty strong trend to the downside. Now let's oppose that with this one right here. See, the red was under the blue, but look at that. It was kind of going sideways, and it wasn't like this big gap. It wasn't a wide gap, kind of going sideways. So that's telling me it's not a really strong downward trend. Right? And again, this is a monthly chart. I'm getting this idea of a big picture. Now, I live in Hawaii, and right over past my screen over here is the ocean. And in the ocean, there, if you were to be high enough up, you'd see that there can be a really, really big wave, and there could be smaller waves inside of that wave. But that big wave is really determining a lot. So that's what we want to do. We want to look at this really big wave of what's happening. So you're going to start by looking at the monthly. Then the next thing that we are going to do is we're going to take a look at the weekly chart. All right, it's basically got the same setup, same moving averages, still got that MACD. Where do you find the weekly? Right here. The only thing that you're doing is you're changing it from monthly to weekly. Now each one of these candles represents 1 week of trading. So generally, there's going to be 4 of these candles inside of a 1 month candle, right? Because generally there's 4 weeks in a month. So we're looking, now we're in this big picture, now we're looking at a smaller picture inside of it. And what do we see happening with that from looking at originally the monthly? Well, we got this kind of weak uptrend with our MACD, and we see our 20-day moving average has already crossed over the 50. So we see our short-term trend has been going down. Our medium-term trend started turning over. Still on the 200-day long, big trend, still going up, but it's getting closer to it. You know, if it keeps on this projection, it's going to be testing that 200-day. We see that the price action, it already fell below the 50-day moving average, tried to rally up to that 50-day moving average, and bounced off, was rejected. Now it's over here. So that's kind of confirming that we're in this downward trend, right? We see that big picture on the monthly was downward. Now we're seeing it tried rallying up, but failed, right? We see that failed attempt here. And then you're going to make your decision on the daily chart. Where do you find the daily? Take a wild guess, right up there. Same place. You just changed that. We changed it from monthly to weekly. Now we're changing it to daily. And so what does that mean? That means now that each one of these candlesticks represents 1 day of trading. Guess how many days there's normally in a trading week? 5. Right? So we went from looking at 30 days of data in one candle on the monthly. Then we broke it down. We opened that candle up, that monthly candle, and we looked inside of it, and we saw the weekly. We saw that we know there's 4 weeks in 1 month. Now we're peeling back the layers, and we're looking even closer. Now we're in 30 days in that, or 5 days in that weekly, right? See how it keeps breaking down lower and lower? Now you could go even further. You could look at a 4-hour chart. You could look at an 8-hour chart. You could look at a 1-hour chart. You could look at a 15-minute chart. But to keep things relatively simple, start with this. All right, so what do we see here on the daily? We see the daily, we're below the 200-day moving average. We're on 1 day for 6 months. So we got 6 months of data going over here. We see the price went below the 200-day moving average back here. Maybe, I mean, right here, maybe even more. But we see that it bounced above this 200-day and it went below it, tested it here, couldn't make it. And we see that the 200-day on the daily's been moving down. We see that the 50-day has kind of been moving down, tried to poke up a little bit. We see that 20-day, right? It's going to be a little more oscillating a little more. Looking at our MACD, we see this downward trend. And so we can look at this, and then we see this right here. Boop, see how it poked up right there, right? Poked up right here, poked up right here. What strike price do you want to sell your call option on? Right? You see that in the next probably month, it's going to continue to go down. So how far away? Here's where it's trading. You know, where do you want to sell? Where do you want your strike price to be? Now, obviously, there's you got to look at how much premium. You know, what did you buy the stock at? There's other things. But now your chart is set up, and now you have a little idea of how you can use this to select a strike price to sell a call option for income on. And then when you figured out that strike price, you're going to place your order on the options chain. We looked at the options chain before, right? We know that over on this side is the puts, but right now we're looking at the calls. We got our expiration date, we got our strike price, which is basically the stock price. All these different keeps going higher. That's where the stock can theoretically trade. We see this 2 different colorations here. It's because the stock is kind of like right around here. It's below $8, trading below 8, but it's probably above 750 or right around there. So everything below where the stock is currently trading is going to be this color. Everything above will be this color. You know, on our example earlier, I went for the $8.50 strike price. And so I would just click that right there, and it brings me to an order screen. Now each broker, they're a little different, so you gotta click around and you gotta figure out what's going to work for you. But this fundamentally is a way that you could start doing it. Start doing it, right? You got an idea, but this is what you should do. If you're relatively new to this stuff, now you got your chart set up. Next thing you do is paper trade. What is paper trading? Per TradingView, paper trading is also known as simulated trading and allows you to trade with fake money. So you can practice buying and selling. Everything is essentially the same as if you were trading with real money, except that you can practice your hand at trading without any of the risk. Now, one thing that's not the same is the emotion's not there. When you're trading with real money, you have different emotions coming up. And so sometimes people will poo-poo paper trading because they say, well, you know, you don't have that real emotion. So even though there's some truth to that, let's look at other things in society and compare and contrast. Doing some simulated training, right? Because that's what paper trading is. You're training how to be successful in the stock market, options market. So what are some other places? How about if you wanted to learn how to fly a plane? Could you see how simulated training might help with that? When I was in the military, we did simulated training. How about this? I think you could really probably get this one. How about you want to learn how to fight? So maybe you join a boxing gym or a kickboxing gym or something like that. Or do you think that you should go to a bar and just start picking fights with people if you wanted to learn how to fight? That you should go, because if you go to a gym, you're not going to get the real emotion, right? It's not the real thing. So if you wanted to learn how to fight, you should just go down to a bar and start picking fights with people. So no, that's probably not what you would do. You'd probably join a gym and there would probably be a coach. And before, one of the first things they'd probably have you do is probably, you know, punching at the air or punching a bag. Why would they have you punch at the bag? There's not the emotion of a real fight, because when you're in a real fight, there's going to be emotion, right? You got to know how to control your emotion. So why is the coach having you punch a bag when there's no emotion? because there's some things that you got to learn before you're ready to master that emotion. And after he had you punch in the bag a little bit, maybe he'd have you hit the mitts where he's moving them around a little bit. So now you got a moving target. And then from there, maybe you'd do some sparring with one of the people. You'd be wearing headgear, mouthpiece, boxing gloves. Why would you do that? Why wear the mouthpiece and the headgear and the boxing gloves? Why not just fist fight each other, right? Because you can get hurt. There's risk, and you don't really know what you're doing yet. And then, all right, so that's kind of how it goes. Wouldn't it be silly just to go down to your local bar, or you had a kid and your son said, hey, you know, I want to learn how to defend myself. Okay, son, let me bring you down to the bar so you can fight adults. Come on, right? That's silly. So paper trade. Find a paper trading account. I personally like Thinkorswim through TD Ameritrade. Also have Webull. I'm not sure if Webull you can use options. I think you can, but I personally like Thinkorswim. Whatever paper trading account you like, find a paper trading account. Start paper trading so you can put some of the stuff. At minimum, you want to learn which buttons to click and stuff. You know, like people have made mistakes. I've made a mistake by just clicking the wrong button on accident. And the last thing I can help you with, go to ihavesuccess.com. Download any of this stuff. This one will be a really good one, right? Getting the cash secured put stock selection guide. Get that. 3 stocks I sell cash secured put options on. Stock option Greeks cheat sheet. 3 underused tactics to transform your financial results. Download all of them. Download one of them, whatever you want. Whenever I make new stuff, it'll automatically be sent to you. And I'll automatically be sending you things every day the market's open that I'm looking at to help you. Do that. Do some paper trading. Do me a favor. Leave a comment here. Introduce yourself. Let me know what's been going on with you. Watch one of these playlists over here. Click the link below. Get your free stuff. You guys have a fantastic day.